Something extraordinary is happening in the silver market right now. And if you're holding silver, thinking about buying silver, or simply trying to understand where global markets are headed, what I'm about to share with you demands your full attention. We're witnessing silver trading at wildly different prices across the world. Not small variations, not typical spreads. We're talking about unprecedented gaps that signal something fundamental is shifting beneath the surface of global commodity markets. In the UAE, silver is changing hands at $170 per ounce. In Japan, $150. In China, $140. Meanwhile, the spot price on Western exchanges tells a completely different story. This isn't just interesting market trivia. This is a flashing signal that reveals critical information about supply chains, currency pressures, investor behavior, and the structural tensions building in the global financial system. Over the next 25 minutes, I'm going to walk you through exactly what's happening, why it matters, and most importantly, what you should be thinking about right now. Whether you're sitting on silver positions or considering entering this market, the decisions you make in the coming weeks could define your financial position for years to come. But here's what we're not going to do. We're not going to hype. We're not going to make predictions about silver hitting some magical price target. And we're absolutely not going to pretend anyone has a crystal ball. What we're going to do is think clearly, examine the evidence, understand the forces at work, and develop a rational framework for decision making. Because that's what separates investors who build lasting wealth from those who get swept up in market euphoria and crushed when sentiment shifts. Let's begin. First, we need to understand what we're actually looking at. When you see silver quoted at $170 in one market and $140 in another, you're not seeing different prices for the same thing in the same moment. You're seeing a breakdown in market efficiency. You're seeing friction in the global trading system, and you're seeing the fingerprints of extraordinary demand pressure. Let me explain the mechanics. Under normal conditions, commodity markets operate with remarkable efficiency. If silver costs significantly less in one location than another, traders will buy where it's cheap and sell where it's expensive. This arbitrage activity naturally narrows price differences to small, manageable spreads that reflect transportation costs, insurance, and local taxes. But when arbitrage breaks down, when those price differences expand beyond what logistics can explain, you're witnessing something profound. You're seeing barriers to the free flow of goods. You're seeing supply constraints. You're seeing panic buying or hoarding behavior. You're seeing currency distortions or capital controls. The premiums we're observing in the UAE, Japan, and China tell us that physical silver is scarce in these markets relative to demand. Buyers are willing to pay substantially above the global spot price because they either cannot source material at spot, or they believe they won't be able to source it at any price if they wait. This phenomenon isn't entirely new, but its scale is remarkable. During previous precious metals bull markets, we've seen premiums expand. In 2020 and 2021, premiums on silver coins and bars reached 20 to 30% above spot in some retail markets. But what we're discussing now appears to be wholesale market distortion, not just retail. Let's talk about what drives this. There are several interconnected factors at play, and understanding them gives you the foundation for rational decision making. First, there's the physical supply chain. Silver mining is concentrated in relatively few countries. Mexico, Peru, China, Australia, and Russia account for the majority of global mine production. Any disruption in production, export restrictions, or logistical challenges can create regional shortages. Second, there's industrial demand. Silver isn't just a monetary metal or investment asset. It's critical for electronics, solar panels, medical equipment, and dozens of other applications. When industrial users compete with investors for available supply, prices respond. Third, there's the paper-to-physical dynamic. Most silver trading occurs in derivative markets, futures contracts, and ETFs that represent claims on silver without immediate physical delivery. When confidence in these paper claims erodes, or when investors demand physical possession, the available physical supply can prove inadequate to meet demand at prevailing prices. Fourth, there's currency devaluation and capital flight. In regions experiencing currency weakness, inflation fears, or financial instability, precious metals serve as a store of value. When citizens rush to convert depreciating currency into hard assets, local premiums spike. Fifth, there's investor psychology and momentum. Markets don't move in straight lines based purely on fundamentals. They move in waves, driven by human emotion, fear, greed, and herd behavior. When enough participants believe prices will continue rising, they pull forward their purchase decisions, creating self-reinforcing demand pressure. Now, let's place this in historical context. Silver has always been volatile. It's more volatile than gold, more volatile than most equity indices, and prone to dramatic moves in both directions. In 1980, silver briefly touched $50 per ounce as the Hunt brothers attempted to corner the market. It then collapsed to single digits and spent 2 decades in the wilderness. In 2011, silver surged to nearly $50 again, amid quantitative easing and fear of currency debasement. It then declined 70% over the following years. In 2020, silver rallied from $12 to nearly $30 in a matter of months as pandemic-era stimulus flooded the system. The point isn't to compare today to any specific historical moment. The point is to recognize that silver moves in cycles, that extremes in both directions are normal, and that price alone tells you nothing about whether an asset is expensive or cheap. What matters is understanding the underlying conditions. And right now, those conditions are genuinely unusual. We're living through a period of persistent inflation concerns, massive government debt levels, geopolitical fragmentation, and declining trust in traditional financial institutions. These are precisely the conditions that historically drive investors toward tangible assets. At the same time, we're seeing the early stages of a global energy transition that requires enormous quantities of silver for solar infrastructure. Industrial demand isn't speculative, it's structural and growing. We're also seeing signs of de-dollarization as countries diversify reserve holdings and reduce dependence on Western financial systems. This manifests as increased buying of gold and silver by central banks and sovereign wealth funds. But here's what you must understand. Just because the fundamental backdrop is supportive doesn't mean prices move in a straight line upward. Markets are forward-looking mechanisms that price in expectations. Often, they overshoot those expectations in both directions. The premiums we're seeing in certain markets could represent the beginning of a broader repricing of silver globally, or they could represent temporary dislocations that resolve as supply chains adjust and speculative fervor cools. Nobody knows which scenario will unfold. Anyone who claims certainty is either ignorant or dishonest. Let's zoom out and examine what else is happening in related markets. Silver doesn't trade in isolation. It exists within an ecosystem of commodities, currencies, and financial assets, all interconnected and influencing each other. Gold, silver's larger cousin, has also been showing strength. Central bank buying has been robust. Retail demand in Asia remains elevated. The gold to silver ratio, which measures how many ounces of silver equal 1 ounce of gold, has been fluctuating significantly. Historically, this ratio has averaged somewhere between 50 and 60. When it rises above 80, silver is considered cheap relative to gold. When it falls below 40, silver is considered expensive. Current levels and recent movements in this ratio provide context for silver's relative valuation. Currency markets are also revealing stress. The dollar's strength or weakness against major currencies influences commodity prices denominated in dollars. When the dollar weakens, commodities typically rise in dollar terms. When the dollar strengthens, they typically fall. But we're also seeing unusual patterns in currency markets, significant interventions by central banks, unprecedented interest rate differentials between countries, capital controls in various jurisdictions. These distortions create opportunities for those who understand them and risks for those who don't. Bond markets, often considered the smartest market participants, are signaling concern about long-term inflation and fiscal sustainability. Yield curves, credit spreads, and real interest rates all contain information about what sophisticated investors expect. When real interest rates, the interest rate minus inflation, are negative, holding non-yielding assets like silver becomes more attractive. When real rates are high and positive, the opportunity cost of holding silver increases. Right now, despite higher nominal rates than we've seen in years, real rates remain relatively low in many jurisdictions when you account for actual inflation experienced by consumers. Equity markets present another piece of the puzzle. When stock markets are surging and risk appetite is high, investors typically have less interest in safe haven assets. When volatility spikes and fear emerges, precious metals often benefit from defensive flows. We're in an unusual environment where certain equity sectors remain strong while others struggle, where concentration in a handful of technology stocks masks weakness elsewhere, and where traditional correlations between assets have become unreliable. This is the context in which silver is trading, not in isolation, but as part of a complex, interconnected global financial system, under significant structural pressure. Let's get specific about silver's supply and demand picture because this forms the foundation of any rational analysis. On the supply side, silver comes from two sources: primary mining and secondary recovery. Primary mining means operations specifically targeting silver deposits. Secondary recovery means silver extracted as a byproduct of mining other metals like copper, lead, and zinc. This matters because it means silver supply doesn't respond to price as directly as you might expect. When silver prices rise, miners of copper and zinc don't suddenly produce more just because the silver they're recovering is worth more. Their production decisions are based on the primary metal they're extracting. Total annual silver supply from mining is approximately 800 million ounces globally. Recycling adds another 150 to 200 million ounces. So total supply runs around 1 billion ounces annually. On the demand side, the picture is complex. Industrial applications consume roughly half of annual supply. This includes electronics, photovoltaics for solar panels, medical applications, and various manufacturing processes. Solar demand alone has grown dramatically and is projected to continue growing as countries pursue renewable energy targets. This isn't speculative demand that disappears when sentiment shifts. It's structural demand driven by policy mandates and technological requirements. Jewelry and silverware account for another significant portion of demand, particularly in markets like India, where cultural traditions drive consistent buying. Investment demand, including coins, bars, and ETFs, represents the swing factor. This is the demand that surges when confidence erodes or when speculation intensifies. And it's the demand that can evaporate when sentiment reverses. Here's the critical question. Is the market in deficit or surplus? Are we consuming more silver than we're producing, or is supply adequate? Recent years have shown modest deficits according to industry reports, meaning consumption exceeds new supply and the gap is filled by drawing down existing inventories. But inventory data is murky, estimates vary, and the true supply-demand balance is subject to significant uncertainty. And what we can say with confidence is that visible inventories at exchanges have declined from peak levels. Whether this represents genuine scarcity or merely shifts in where material is stored is open to interpretation. What we can also say is that when investors collectively decide they want physical possession rather than paper claims, the available supply at prevailing prices can prove shockingly small relative to the size of derivative markets. This brings us to a critical concept: the difference between price discovery in paper markets and the reality of physical availability. Futures markets and ETFs provide liquidity and allow price discovery with minimal friction. You can buy or sell exposure to millions of dollars worth of silver with a few clicks. But this ease masks the fact that physical delivery at scale is far more difficult. When everyone is content to trade paper claims, the system functions smoothly. When a meaningful percentage of participants demand physical delivery simultaneously, stress emerges, premiums spike, delivery delays occur, and prices in physical markets can decouple from paper market quotes. Is this what we're seeing now in the UAE, Japan, and China? Possibly. Or we could be seeing temporary logistical issues, import duty effects, or local speculation that will normalize quickly. The honest answer is we're seeing smoke. Whether there's fire underneath requires careful monitoring of how the situation evolves. If you're currently holding silver, either as coins, bars, or through vehicles like ETFs or mining stocks, your decision framework differs fundamentally from someone considering new positions. You already have exposure. You've already made an allocation decision. Now you're asking whether to hold, add, reduce, or exit entirely. Let me give you a framework rooted in rational portfolio management rather than emotion. First, revisit your original thesis. Why did you buy silver in the first place? Was it a speculation on rising prices? Was it portfolio diversification? Was it insurance against currency debasement or financial system instability? Was it conviction about industrial demand growth? Your original thesis matters because it determines your holding period and your exit criteria. If you bought as a trade expecting quick gains, your approach differs from someone who bought as long-term wealth preservation. Second, assess your position size relative to your total portfolio. What percentage of your net worth is in silver? If it's a small allocation, 2 to 5% perhaps, short-term volatility matters far less than if it's 20 or 30%. Concentration creates risk. It also creates opportunity, but it demands more active management and clearer exit plans. Third, consider your cost basis. Are you sitting on substantial gains or are you underwater? This shouldn't determine your strategy entirely, but it influences tax implications and psychological factors. If you're significantly profitable, taking some profits to reduce position size and lock in gains is a rational strategy. You're removing emotional pressure and ensuring you benefit from the move that already occurred. If you're underwater, the decision is harder. Selling at a loss is painful, but sometimes necessary if your thesis has broken or if capital is better deployed elsewhere. Fourth, think about rebalancing. If silver has appreciated substantially and now represents a larger portion of your portfolio than intended, rebalancing back to your target allocation makes sense. This is buying low and selling high in practice, maintaining discipline rather than chasing momentum. Fifth, consider diversification within precious metals. Do you hold only silver, or do you also hold gold? Do you hold physical metal, mining equities, or streaming companies? Each has different risk-return characteristics. Physical metal has no counterparty risk but generates no income. Mining stocks offer leverage to metal prices but carry operational and management risks. Streaming companies provide exposure with different business models. A diversified approach reduces specific risks. Here's what you should not do. Don't make decisions based purely on recent price action. The worst mistake existing holders make is selling in panic during corrections or refusing to take profits during euphoria because they're convinced prices will go much higher. Markets don't care about your feelings. They don't care that you held through volatility or that you believe in the asset. They will test your conviction repeatedly, have predetermined rules, not rigid, inflexible rules that ignore changing conditions, but thoughtful guidelines that help you act rationally when emotions run high. For example, if my silver position exceeds 10% of my portfolio, I'll trim to 8%. Or I'll take 25% profits if prices double from my entry point. Or I'll add to positions only if prices decline more than 30% from recent highs. These rules won't be perfect. No rules are. But they provide structure and prevent the emotional whiplash that destroys wealth. Pay attention to market structure, not just price. Are premiums expanding or contracting? Is physical availability improving or worsening? Are other investors rushing in or pulling back? These signals tell you about the character of the move. Sustainable trends are built on gradually expanding participation and improving fundamentals. Blow-off tops feature parabolic price moves, media frenzy, and everyone claiming it's different this time. Finally, maintain liquidity. Don't have 100% of your silver holdings in illiquid forms or locked in long-term positions. Keep some portion accessible so you can respond to opportunities or requirements without forced selling at inopportune moments. If you don't currently hold silver and you're wondering whether now is the time to buy, you're in a different position entirely. You have optionality. You can wait, watch, and choose your moment. You're not managing an existing position. You're making a fresh allocation decision. This is both an advantage and a trap. The advantage is patience. The trap is paralysis or FOMO, fear of missing out. Let's build a rational framework for new position consideration. First, understand what silver is and isn't. Silver is not a get-rich-quick scheme. It's not a substitute for building skills, earning income, or running a business. It's a portfolio component that serves specific purposes: diversification, inflation hedge, industrial commodity exposure, and potential appreciation. If you're looking at silver because you think it's going to rocket upward and make you wealthy overnight, stop. That's gambling, not investing. Second, assess your overall financial situation. Do you have emergency savings? Are high-interest debts paid off? Are retirement accounts funded? Are you investing consistently in diversified assets? Silver, or any precious metal, should never come before these fundamentals. You don't put money into volatile commodities if you might need that money for rent next month. Third, determine appropriate allocation. For most investors, precious metals as a total category might represent 5 to 15% of a portfolio. Within that, the split between gold and silver depends on risk tolerance and conviction. Silver is more volatile than gold. It offers higher potential returns and higher potential losses. A conservative approach might be 70% gold, 30% silver within your precious metals allocation. A more aggressive approach might be 50-50 or even weighted toward silver. But this should be a conscious decision based on your situation, not a random guess or someone else's recommendation. Fourth, decide between physical and paper. Do you want actual coins and bars in your possession, or are you comfortable with ETFs, mining stocks, or futures? Physical has advantages: no counterparty risk, tangible ownership, privacy. It also has disadvantages: storage requirements, security concerns, premiums above spot price, liquidity when selling. Paper vehicles offer convenience and liquidity, but expose you to issuer risk, management fees, and potential disconnects between paper prices and physical availability. Many investors split the difference. Some physical for long-term holding and emergency scenarios, some paper for liquidity and tactical positions. Fifth, consider dollar cost averaging versus lump sum investment. Given silver's volatility, buying your full intended position all at once exposes you to timing risk. You might buy right before a significant correction. Dollar cost averaging, buying fixed amounts on a regular schedule regardless of price, reduces timing risk and removes emotion from entry decisions. Over months or years, you accumulate positions at various prices, smoothing out volatility. The trade-off is that if prices run significantly higher, you'll have less exposure than if you'd bought everything up front. There's no perfect answer, only trade-offs based on your risk tolerance and conviction level. Now, let's address the elephant in the room. Given the current premiums in certain markets, given the signals we're seeing, should you be rushing to buy silver right now? Here's my answer. Rushing is never the right approach. Acting with urgency when you understand your thesis and have a plan is different from panicked buying because prices are moving. If you've studied silver, understand the risks, determined your appropriate allocation, and have been waiting for catalyst or confirmation, the current environment might provide that confirmation. But if you're just now hearing about silver because prices are moving and premiums are expanding, you're late to this specific move. That doesn't mean you shouldn't invest in silver at all. It means you should be especially cautious about buying into momentum without understanding what you're doing. Consider this scenario. Premiums are high right now in certain markets. If you pay $170 per ounce in the UAE when spot is significantly lower, you're starting with a substantial premium that must be overcome just to break even. If physical availability improves and premiums contract, you could be underwater even if spot prices rise modestly. This is the danger of chasing scarcity without understanding the bigger picture. A patient approach might be start researching and educating yourself now. Begin small positions to gain experience with the asset class. Watch how the market evolves. Scale up gradually as you gain confidence and understanding. This won't give you the bragging rights of calling the bottom perfectly, but it will help you avoid the painful losses that come from impulsive decisions made in the heat of market moves. Let me be direct about the mistakes that destroy wealth in precious metals markets. These aren't theoretical dangers. They're patterns repeated countless times across market cycles. Mistake number 1, emotional decision-making. Buying because you're excited about rising prices. Selling because you're terrified of losses. Adding to positions because you can't stand missing out. These emotional responses are natural but deadly. The market feeds on emotion. It takes money from emotional participants and transfers it to disciplined ones. If you can't control fear and greed, you will lose money regardless of whether your fundamental analysis is correct. Mistake number 2, over-leveraging. Using borrowed money to buy silver, whether through margin accounts, futures contracts, or personal loans, magnifies both gains and losses. Silver's volatility means that even if your long-term thesis is correct, short-term swings can force liquidation at the worst possible time. Leverage turns volatility from inconvenient to catastrophic. If you can't afford to own silver with cash, you can afford to tie up long-term. You shouldn't own it at all. Mistake number 3, ignoring position sizing. Putting too much of your wealth into any single asset, no matter how compelling the thesis, creates unacceptable risk. I don't care how certain you are. I don't care how much research you've done. Concentration without diversification is speculation, and speculation destroys more wealth than it creates. Mistake number 4, chasing performance. Buying what's already moved dramatically because you assume the move will continue. This is how investors end up buying tops and selling bottoms. Strong recent performance tells you about the past, not the future. Often, the best opportunities are in assets that have been ignored, not those making headlines. Mistake number 5, trusting sources with conflicts of interest. Silver dealers want you to buy silver. Mining company executives want you to buy their stock. Media personalities want clicks and views. Everyone has an agenda. Understand those agendas before accepting anyone's analysis or recommendations. Ask yourself, what does this source gain if I follow their advice? Mistake number 6, failing to plan for different scenarios. Only considering the upside case while ignoring how you'll respond if you're wrong. What if silver falls 30%? What if premiums collapse? What if your thesis takes 5 years to play out instead of 5 months? What if geopolitical tensions ease and demand slows? Not having answers to these questions means you're gambling, not investing. Mistake number 7, neglecting tax implications. Precious metals have specific tax treatment in many jurisdictions. Gains may be taxed as collectibles at higher rates than long-term capital gains. Frequent trading can create short-term rather than long-term treatment. Ignoring taxes doesn't make them go away. It just means you'll have unpleasant surprises that reduce your actual returns. Mistake number 8, confusing price with value. Something becoming more expensive doesn't make it a better investment. Something becoming cheaper doesn't automatically make it a bargain. Value depends on fundamentals, future prospects, and your required return. Price is what you pay. Value is what you get. They're often disconnected. Mistake number 9, following the herd. When everyone is buying, risk is highest. When everyone is selling, opportunity often emerges. But doing the opposite of the crowd requires conviction, analysis, and courage. Most investors lack the discipline to be contrarian when it matters. They join the crowd for emotional comfort, then suffer the consequences when the crowd is wrong. Mistake number 10, giving up on fundamentals. Concluding that because markets can stay irrational longer than you can stay solvent, fundamentals don't matter. Fundamentals always matter. Eventually. But eventually can be years, and timing matters tremendously. The solution isn't to ignore fundamentals. It's to combine fundamental analysis with position sizing, risk management, and patience. If you can avoid these 10 mistakes, you're ahead of 90% of market participants. Not because you're smarter, but because you're more disciplined. Let me address something that doesn't get discussed enough in financial analysis: the psychological challenge of investing in volatile assets. You can have the best analysis in the world. You can understand supply and demand, monetary policy, and market cycles. But if you can't handle the emotional roller coaster, none of it matters. Silver, more than almost any other asset, tests investor psychology. It moves violently in both directions. It inspires passionate belief among advocates and dismissive scorn among critics. It can make you feel brilliant one month and foolish the next. This is intentional market design. Not literally intentional, but functionally. Markets evolve to separate committed participants from weak hands. They create conditions that force emotional decisions from the undisciplined. When silver surges, you'll feel euphoric. You'll be tempted to add more, to leverage up, to tell everyone you know. This is exactly when you should be most cautious. When silver crashes, you'll feel sick. You'll question your analysis. You'll be tempted to sell to stop the pain. This is exactly when selling is usually wrong if your thesis remains valid. The solution isn't to become emotionless. That's impossible and probably unhealthy. The solution is to build systems that help you act rationally despite emotions. Written investment plans, preset rules for adding or reducing positions, regular reviews on a schedule, not triggered by price moves, separation of long-term holdings from trading positions. These systems won't eliminate emotion. They'll provide guardrails that keep emotion from derailing your strategy. Another psychological challenge, dealing with uncertainty. We crave certainty. We want to know what will happen. But markets don't provide certainty. They provide probabilities, scenarios, and risk-adjusted possibilities. Learning to act decisively while acknowledging uncertainty is one of the most valuable skills an investor can develop. It's the opposite of paralysis and the opposite of recklessness. It's informed action with managed risk. Finally, there's the challenge of patience. We live in an instant gratification culture. We expect quick results, but building wealth through investing is a long-term game. Silver might take years to deliver on its fundamental promise, or it might move quickly and then consolidate for extended periods. Your ability to wait, to endure boredom and frustration, will determine your success more than your ability to analyze supply curves. Before we conclude, let's place silver in the context of the broader financial transformation we're living through. We're in a period of extraordinary change. The post-World War II monetary order is under stress. The dominance of the dollar faces challenges. The relationship between governments and citizens around money is evolving. Technology is creating new forms of value storage and transfer. In this environment, hard assets, tangible commodities, and real things have appeal that paper claims lack. This isn't nostalgia for the gold standard or technological regression. It's a rational response to unsustainable fiscal trajectories and monetary experiments. Central banks have expanded balance sheets to unprecedented levels. Government debt in major economies has reached peacetime records. The line between monetary and fiscal policy has blurred. The consequences of these policies are playing out in real time. Inflation, whether measured accurately or not, erodes purchasing power. Currency debasement, whether intentional or consequential, reduces the value of savings. These aren't political statements, they're mathematical realities. In this context, silver serves multiple roles. It's an industrial commodity benefiting from technological transformation. It's a monetary metal with thousands of years of history. It's a portfolio diversifier with low correlation to other assets. It's a tangible store of value, but it's not a solution to all problems. It's not a substitute for productive skills, entrepreneurship, or creating value. It's a component of a broader financial strategy. The premiums we're seeing in certain markets might be signaling the early stages of a broader repricing, or they might be temporary dislocations. Either way, they're reminding us that physical commodities have different characteristics than financial assets. You can't print silver, you can't create it through monetary policy, you can only mine it, refine it, and trade it. This fundamental scarcity is both its appeal and the source of its volatility. We've covered substantial ground. Let me bring this together with clear, actionable takeaways. The silver market is showing unusual characteristics right now, significant premiums in certain regions, supply chain signals that merit attention, a fundamental backdrop that's genuinely supportive. But unusual doesn't mean unprecedented. Supportive doesn't mean guaranteed. Attention grabbing doesn't mean actionable without careful thought. If you're holding silver, revisit your thesis. Check your position size. Consider taking some profits if you're substantially ahead. Maintain discipline around rebalancing. Don't let recent price action override your strategic plan. If you're considering silver investment, start with education. Determine appropriate allocation. Consider dollar cost averaging. Choose between physical and paper based on your situation. Don't rush in because of FOMO. If you're watching from the sidelines, keep learning. Monitor how these premiums evolve. Study the relationships between silver and other assets. Build knowledge so that when opportunity appears, you're prepared to act with confidence. For everyone, remember the fundamentals of sound investing: diversification, position sizing, risk management, emotional discipline, long-term perspective. Markets will continue doing what markets do, moving in cycles, creating winners and losers, rewarding discipline and punishing impulsiveness. Your job isn't to predict the future. It's to position yourself to benefit from multiple possible futures while protecting yourself from catastrophic losses in any of them. Silver might deliver extraordinary returns over the coming years. It might languish and frustrate believers. Most likely, it will do both, repeatedly, testing your conviction and your discipline. The investors who succeed won't be those who called the exact bottom or top. They'll be those who managed risk, controlled emotion, and maintained strategic perspective when everyone around them was panicking or euphoric. This is not easy. If it were easy, everyone would be wealthy. But it is simple. not complicated, just demanding of qualities that anyone can develop: patience, discipline, rationality, and humility. The silver market is sending signals right now. What you do with those signals depends entirely on your situation, your goals, your timeline, and your risk tolerance. Make decisions that you can live with through both upside and downside. Build positions that help you sleep at night, not that keep you checking prices every hour. Invest amounts you can afford to tie up long-term without stress. And above all, remember that you're building long-term financial security, not gambling on short-term price movements. That mindset difference, more than any analysis of supply and demand, will determine your ultimate success. The opportunities in silver, in precious metals broadly, and in tangible assets are real. So are the risks. Navigate both with clear eyes, rational thought, and disciplined execution. The market doesn't care about your opinion. It doesn't care about mine. It will do what it does based on the collective actions of millions of participants, each with their own motivations and constraints. Your only job is to understand yourself, your goals, and your strategy well enough that you can act rationally regardless of what the market does tomorrow, next month, or next year. That's how wealth is built. That's how financial security is created. That's how you position yourself to benefit from opportunity while surviving inevitable periods of challenge. The current situation in silver markets is worth your attention. But attention alone isn't enough. Combine it with analysis, discipline, and action aligned with your broader financial strategy. Do that, and you'll be positioned well, regardless of whether silver goes to 100, 200, or back to 30. You'll have acted rationally, managed risk appropriately, and given yourself the best possible chance of long-term success. That's all any of us can do, and it's enough. Thank you for your attention these past 25 minutes. I hope this framework serves you well in the decisions ahead. Stay rational, stay disciplined, and stay focused on what truly matters: building lasting financial security through sound principles applied consistently over time.